Banks can start paying dividends. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. I thought we'd have a look at this article from news.com.au which is discussing, APRA allowing the banks to pay dividends. Isn't that nice? Isn't that nice? We're definitely not in a planned or controlled economy at all, where you need to get permission to pay dividends. But I can't say the banks are the heroes of anyone here, and, no one is a big fan. But there are a lot of people that love banks because of their steady dividend stream. There are a lot of people that depend on banks for their steady dividend stream. That's the whole point of investing in them. And before we go through this article, let's just jump over and have a look at the share price. So Commonwealth Bank, it's now sitting at $73. It bottomed out in the lowest it received. It hit, remember, back in March, down to about 54, and that was just before a February peak of $90. We go to 5 years. We'll go to max. Yeah, it got a bit higher. Did it beat it back then in 15? Almost. So we'll have to see if this action here, this growth since the beginning of May, is pricing in this, return to dividends, or if it'll climb even more. And they've got the P to E, price to earnings, of 13.25. We go to Westpac, their P to E 13.29. They haven't jumped recently. They haven't jumped, not as much as Combank. They're sitting at 17.70. They're up 1.37%. In Feb, they're at $25. And we'll go to the Max Starter. And they peaked in 15 as well at $39. We have a look at ANZ. They're at 12.56 price to earnings. Right now they're sitting at 18.45, up 2%. In Feb, it was over $27. They took a hit like everyone else. Let's go to the Max Data. How were they sitting in 15? $36.80. And then NAB. Looks like they're trading sideways at the moment. 18.18, up 1.56%. They were down to $14.40 from $27.41 in Feb. P to E isn't as good as the others at 16.32. Go out to the Max Data, and they were not as exciting as any of the others in 15. You have to go a bit further back, just before the GFC, when they had nice nearly $40. So let's have a look at this and see, are you invested in the Big Four? I know a lot of people use it for dividends. There's all the people who set up dividend portfolios to get a monthly payment, or they reinvest it. So it'll be interesting to see how these shares go. The banking regulators' concern for Australia's financial industry have eased, with banks able to resume paying dividends to shareholders. The Australian Prudential Regulation Authority has wound back its capital management guidance placed upon the banking and financial services sector after the onset of the pandemic created an uncertain economic outlook. So is this telling us that APRA are less concerned about the future of the economy? They're hoping things will return. We'll have to see if we get more lockdowns, more restrictions, more border closures, more dire economic news, if they'll come back and put their foot down again, restrict dividend payments. APRA had warned major banks to scrap planned dividend payments to shareholders over fears the payments would impact the financial institution's capital and free cash flow positions. The regulator said while conditions had improved, banks should still maintain caution in planning capital distributions, including dividends. APRA Chair Wayne Burns said the update strikes a balance between the bank's need to continue strong capital management and supporting customers and stakeholders. Although the environment remains one of heightened risk, we now have a stronger sense of how Australia's economy and financial institutions are being impacted by the pandemic, he said. Well, what we could see here, would this also, facilitate a greater push from shareholders insisting on or expecting a dividend payment, and then the banks going around and doing the tap on the shoulder going, you got to sell, you got to sell, you got to sell. On that basis, APRA believes that banks and insurers do not need to continue to defer capital distributions, provided they can moderate payments to sustainable levels based on robust stress testing and continue to prioritize supporting their customers and the economy. APRA has recommended the banking sector should, for the remainder of the calendar year, seek to retain half of its earnings when planning for capital distributions, such as dividend reinvestment plans and dividend payouts to shareholders. So, they're going to, looks like we'll have dividends cut in half. So if we have a look here, what's NAB? The dividend yield is 6.22%. ANZ, 8.67%. Westpac Corp, 9.83%. And CBA at 5.9%. So you're looking at what, 3% for CBA roughly, 4.5%, 5% for Westpac, ANZ, 4.5%, NAB at 3%. Not over the year, it'll put a dent in it, but still, we'll have to see. What do you think? It also said banks may continue to conduct regular financial stress tests to ensure ample liquidity. Capital buffers should also be able to absorb the economic downturn by continuing to support households and businesses through loans from lending support packages. So we're going to have continued loan deferrals next year. Are we going to have continued loan deferrals from next year? In the current environment, banks face additional challenges to their capital resilience, including the material volume of loan repayment deferrals, greater financial impact from the pandemic, and restrictions on dividends from their New Zealand operations, Mr. Burns said. APRA has therefore set an expectation that dividend payout ratios for ADIs, authorised deposit-taking institutions, will remain below 50% for this year. So we're going to have bank payments or dividends below 50% for this entire year. So we'll have to watch and see how the market responds to this latest information from APRA. Because I'll be interested, frankly, I'll be interested to keep an eye on these prices. We'll have a look at the last 5 days, because this article came out yesterday at 12:55 p.m. At 12:55 p.m. So we'll go 1 day. So that was, there we go, so right about here. So it went from 1821 for National Australia Bank and closed the day at 1818. So it's no difference at all. Has this been priced in? Was this anticipated back here? So NAZ, National Australia Bank, no difference. Let's look at ANZ. We'll go to 1 day. Was it 12:55? It was at 1842. It finished the day at 1845. So one few cent difference. Hardly anything. Westpac. What was it? 12:55. At 1772. Finished the day at 1770. So again, slightly down, a pretty insignificant move. And then we'll go here. We've got Commonwealth Bank. Where was it? 12.55 at $72.99, and it finished the day at 2 cents up. 2 cents up. So from when this article was written, but it said, the data was released the day before, the day here. That could be the jump there. We'll jump here. Same thing could be the jump, profit taking and slowly climbing up. The jump, profit taking, slowly climbing up. Jump, profit taking, and slowly climbing up. So we're starting to see a pattern here. So are you a fan of investing in the banks for, well, the dividend or for capital growth? Do you think this will affect their price? And, do you think they're going to have enough reserves, or it will kind of give them a nudge to start putting pressure on people to get out of their, risky loans if they can't manage it? Let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy our merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone, and I'll see you in the next video.